The ethics of asset stripping. In this video assignment, we will explain the procedure of asset stripping, we will give a new model of financial ethics, we test this model on a case study, finally we give you our conclusions and offer recommendations. So let us start. Example 1. Imagine a company of 3 branches. The big and small one make a loss. The middle one makes a profit. A private equity fund gains control of the company. It sells the profitable part, while the other parts go bankrupt. Example 2. A rhinoceros gets killed. The ivory horns are stripped and sold for a generous amount. Both cases are examples of asset stripping. The case with the rhino seems clearly unethical. But what about the company? How do you know what behavior is right? This is the subject of financial ethics. A financial ethical approach consists of justice, sustainability, nature, risk and return, participants, and legitimacy, all of which are monistically interconnected. Let us put the financial ethical model into practice with the case study of Phones4you and BC Partners. We introduce the case with a news headline of BBC.
Now we start with Phones4you. All Phones4you stores will be closed today. Staff have been told to turn up to work as usual, where they're going to be briefed on the retailer's future. There are nearly 5,600 jobs at risk at the company.
And now for the analysis of the Financial Times reporter.
What didn't help, obviously, is BC Partners potentially didn't help, at least. This is what Vodafone alleges, is that BC Partners gave the company less wriggle room to offer better terms to its mobile partners by withdrawing about £200 million worth of equity from the company last year in what's called a dividend recap. Effectively means putting debt into the balance sheet and taking the money out as a one-off payment.
Let us reconstruct the takeover of Phones4you by BC Partners. Phones4you sells mobile phones with over 600 stores in the UK. Private equity fund BC Partners wants to acquire Phones4you. It borrows additional money from London City investors. BC Partners gains control of Phones4you. First order of business is the dividend payout equal to the money invested. Secondly, it strips and sells the Lifestyles Group. A second dividend payout follows. The contractors of Phones4you consequently abandon their partnership. This has detrimental effects on the company's financial obligations. Phones4you can't pay its employees, give return to investors, pay its debts to suppliers, pay taxes or service to customers. Phones4you goes bankrupt, along with most stores. All is left are layoffs and unpaid debts. Let us measure the case study along the criteria of the ethical model. Aristotle stated in his writing Ethica Nikomachia that a just transaction is one in which both parties gain equal value. This is certainly not the case, since investors have made great losses while BC Partners enjoyed a £1 million profit. Sustainability is concerned with the interest of different generations. Simply put, what are the effects on the future economy? The management's decisions do not score very high on this criterion. BC Partners did not pursue a stewardship theory, but rather an agency perspective, in which the future effects on other stakeholders are not taken into account. Although the market for mobile phones changed, BC Partners' strategy left the economy with debts, layoffs, and presumably distrust in the sector. Although the production of mobile phones has some negative effects on nature, BC Partners is not to be blamed for this. An important theory in risk and return is the capital asset pricing model. This theory states that a higher risk level has a positive effect on the expected return. A note here is that the theory assumes that we can predict the expected returns. When we analyze a risk distribution, we must conclude that most risks were with the investors and employees. With BC Partners' dividend payout, their risk was greatly reduced, and with it, the contribution to the real economy plummeted, with clear effects for the employees and suppliers. Could Phones4you still be a viable company? We can't be sure. However, in the decision-making by BC Partners, The interests of the other stakeholders were not taken into account, albeit, and it could and probably should, involve all participants. For an ethical perspective on legitimacy, let's take a look at Harvard professor Michael Sandel.
In order to decide where markets serve the public good and where they don't belong, we have to do more than ask about economic efficiency and how incentives will work. We also have to ask about whether introducing money into a certain practice will dissolve or displace or crowd out goods, attitudes, norms, values worth caring about.
Though every commercial company has profit-driven incentives, the character of BC Partners' strategy with Phones for You eroded what Sandel calls norms we care about, which in this case are investors' trust and the interest of workers. In that sense, BC Partners' activity lacked moral legitimacy. It is time to come to our conclusions. First, asset stripping can have a valuable disciplinary function, but only when all participants benefit from it. Second, the case of Phones for You shows an example of asset stripping in which only one party benefited. This is not conform to described financial ethical norms. Third, asset stripping can only be viable if the raider company is aware of the negative effects and is driven by long-term gains. Finally, let's go to our recommendations. First, asset stripping is in no need for new hard regulations. We recommend to jointly with the buyout industry to set up soft regulations in order to improve trust in the takeover business and awareness of the negative side effects of short-term asset stripping. Secondly, there is a need for understanding of the spirit of the law. Therefore, a comply or explain mechanism in which companies explain the goals of the asset stripping or otherwise refrain from doing so will get the right interests on board. Thirdly, we advise corporate raiders to adopt a more long-term perspective and include, amongst others, employees, suppliers, or the government in a potential asset strip. Fourthly, we encourage to persuade employees, suppliers, and other stakeholders to become shareholders of the company in order to give them a say in the sale.